Hi, this is the first video of what I hope to be a long series where I learn investments, finance, and um, economics, and you can learn it with me. I'm starting this as a way for me to be consistent with um, with these things, and I've always tried to be, but I'm thinking, why not try this method of recording a video every day, and hopefully, who knows, maybe I finally will become consistent because of this method. And for the beginning, 1 or 2 months, or however long it'll take, I'll keep all these videos private. But if somehow I'm able to stay consistent past that period, I will make them public if the quality is good and I feel that, you know, I'm comfortable sharing this with the public. And even if it doesn't, gain any views at all, I do not care. It is just for me. And in the long term, if it helps another kid who's not that confident in you know finance and economics and investments and stocks and all this stuff, and feels really confused and doesn't know where to start and everything, this is a good place, I feel. You can learn it with me. I don't know any more than you do, probably. I know probably less than you do. It's chances that that's the case. So this is the first time I'm recording any content of any sort. So yeah, let's just get to it. So this is the book, and it's called Investments. It's by Bodie, Kane, and Marcus. And I've had this book for like 1.5 years, but actually I've done the first two chapters, but then after that I just couldn't like stick with it. But I am going to do it again right from the very beginning, so that there's no gap also in my memory, because it's been so long since I did those two chapters. So yeah, this book, I like to call it like the Bible of investments or finance, or all these things. And it's really nice for me. It's really comforting for me to have this book on hand. And yeah, anyways, the brief contents are, there are I think 7 parts, if I'm not mistaken. Yeah. So the first part is the introduction, which has 4 chapters: investment environment, asset classes, financial instruments, how securities are traded, and mutual funds and other investment companies. Those are the 4 chapters. Part 2 is portfolio theory and practice. So we have risk, return, and historical record, capital allocation to risky assets, optimal risky portfolios, index models. Part 3, we have equilibrium in capital markets, the capital asset pricing model, arbitrage pricing theory, and multi-factor models of risk and return, the efficient market hypothesis, behavioral finance and technical analysis, empirical evidence on security returns. And then part 5, we have fixed income securities, bond prices and yields, the term structure of interest rates, managing bond portfolios. And then part 5, we have, sorry, that was part 4. I might have said part 5, but yeah. Part 5, we have security analysis, macroeconomic and industry analysis. That's very interesting for me. Equity valuation models, financial statement analysis. That's like the tricky part, since I never liked accounting in school. So yeah. Part 6 is options, futures, and other derivatives. Options markets introduction, option valuation, future markets, futures, swaps, and risk management. Part 5 is applied portfolio management, portfolio performance evaluation, international diversification, hedge funds, the theory of active portfolio management, investment policy, and the framework of the CFA Institute. So, by the way, I've never like read the brief contents like fully, because yeah, I've never gone past the second chapter, asset classes and financial instruments. So yeah, I am a complete beginner in this book. Like I don't know anything, just pretty much clean slate, just starting out. And I always think I'm so late, and everybody else has everything, and they know everything. They've got everything figured out. They've got all the internships. They've got all the grades. They've got all the connections and everything, and I have nothing. But it's better late than never. I'm just 19, and I see a lot of people who are in their 40s, 50s, who just are getting into finance and investments and economics and stuff, like how to make the market work for you and everything. And I think when I see those things, and when I see those people online, obviously, or even in real life, I find out that actually I'm not that behind at all. I'm actually pretty ahead, and I have the chance to be pretty ahead. So, yeah, this is me just finding or trying to find a way for me to work and for me to have a passion and be driven in something that I like and to find some purpose in my life, honestly. So, anyways, enough of that self talk. We're just gonna start with the part one introduction, the investment environment. So that is our first chapter, which we are gonna do today. And I actually have to go to the gym in like 15 minutes or something. So I was just like, quickly just do like a quick video, not too much, but I just wanted to get like started really. And as you can see, I've completely ruined this book with like highlighting every line because I'm a very inefficient reader, so I might say. So I feel like I have the need to like underline every line just to be able to focus. But yeah. Sorry for that. Yeah, let's just begin. So I'll not move the book since it's in frame. But yeah, the investment environment. An investment is the current commitment of money or other resources in the expectation of reaping future benefits. For example, an individual might purchase shares of stocks, anticipating that the future proceeds from the shares will justify both the time that her money is tied up as well as the risk of the investment. The time you will spend studying this text, not to mention its cost, is also an investment. And also the time you are spending to watch this video, if anybody watches this video ever in his life, is also an investment. You are foregoing other current leisure or in the income you could be earning at a job in the expectation that your future career will be sufficiently enhanced to justify this commitment of time and effort. While these two investments differ in many ways, they share one key attribute that is central to all investments. You sacrifice something of value now, expecting to benefit from that sacrifice later. This text can help you become an informed practitioner of investments. We will focus on investments in securities such as stocks, bonds, or options, and future contracts. But much of what we discuss will be useful in the analysis of any type of investment. The text will provide you with background in the organization of various security markets, will survey the valuation and risk management principles useful in particular markets, such as those for bonds or stocks, and will introduce you to the principles of portfolio construction. Broadly speaking, this chapter addresses three topics that will provide a useful perspective for the material that is to come later. First, before delving into the topic of investments, we consider the role of financial assets in the economy. We discuss the relationship between securities and the real assets that actually produce goods and services for consumers, and we consider why financial assets are important to the functioning of a developed economy. Given this background, we then take a first look at the types of decisions that confront investors as they assemble a portfolio of assets. These investment decisions are made in an environment where higher returns usually can be obtained only at the price of greater risk, and in which it is rare to find assets that are so mispriced as to be obvious bargains. These themes, the risk return trade off and the efficiency pricing of financial assets, are central to the investment process. So it is worth pausing for a brief discussion of their implications as we begin the text. These implications will be fleshed out in a much greater detail in the later chapters. We provide an overview of the origin organization of security markets as well as the various players that participate in those markets. Together, these introductions should give you a feel for who the major participants are in the securities markets, as well as the setting in which they act. Finally, we discuss the financial crisis that began playing out in 2007 and peaked in 2008. The crisis dramatically illustrated the connections between financial system and the real side of the economy. We look at the origins of this crisis and the lessons that may be drawn from about the systemic risk. We close the chapter with an overview of the remainder of the text. So that was the introduction for the first chapter, the investment environment. And yeah, I think I'll just do real assets versus financial assets for today. This is the 1.1, and then I'll end the video because, as I said, I have to go to the gym. But yeah, let's just get on with it. Real assets versus financial assets. The material wealth of a society is ultimately determined by the productive capacity of its economy. That is, goods and services its members can create. This capacity is a function of the real assets of the economy. The land, buildings, machines, and knowledge that can be used to produce goods and services. In contrast to real assets are financial assets, such as stocks and bonds. Such securities are no more than sheets of paper, or more likely computer entries, and they do not contribute directly to the productive capacity of the economy. Instead, these assets are the means by which individuals in well-developed economies hold their claims on real assets. Financial assets are claims to the income generated by real assets, or claims on income from the government. Okay, if we cannot own our own auto plant, a real asset, we can still buy shares in Ford or Toyota, financial assets, and thereby share in the income derived from the production of automobiles. While real estate while real assets, not real estate, while real assets generate net income in the economy, financial assets simply define the allocation of income or wealth among investors. Individuals can choose between consuming their wealth today or investing for the future. If they choose to invest, they may place their wealth in financial assets by purchasing various securities. When investors buy these securities from companies, the firms use the money so raised to pay for real assets, such as plant, equipment, technology, or inventory. So, investors' return on securities ultimately come from the income produced by the real assets that were financed by the issuance of those securities. The distinction between real and financial assets is apparent when we compare the balance sheet of US households shown in table 1.1. So this is a table, and I'm pretty sure you can't read it because it's very small and it's marked by all these lines that I made. But yeah, I'm just going to explain what's shown in the table. It's a balance sheet of US households. So one second. With the composition of national wealth in the United States, shown table 1.2. Okay, household wealth includes financial assets such as bank account, corporate stock, or bonds. However, these securities, which are financial assets of households, are liabilities of the issuers of the securities. For example, a bond you treat as an asset because it gives you a claim on interest income and repayment of principal from Toyota is a liability of Toyota, which is obligated to make these payments to you. Your asset is Toyota's liability. Therefore, when we aggregate over all balance sheets, these claims cancel out, leaving only real assets as the net wealth of the economy. National wealth consists of structures, equipment, inventories of good, and land. We will focus almost exclusively on financial assets, but you shouldn't lose sight of the fact that the success or failures of financial assets we choose to purchase ultimately depend on the performance of the underlying real assets. So I think what this 1.1 part is trying to say is that although we may own financial assets like stocks and bonds, those things are just claims, are just like fictional claims, but they're real. But we made them up on income derived from the production that real assets bring. Like it gave the example like of a factory. We cannot own a factory because we're not that rich, obviously, but we can buy a few shares of a company that owns a factory. So therefore, when we do that, we are actually getting a portion relative to the number of shares we bought of the income that is produced by that factory. And by those real assets, we actually cannot buy because we're not that wealthy, like I said. So this is the 1.1 first chapter, first everything, first video, introduction, everything. And I think it went pretty good. I mean, again, I'm just reading this like a book. It's pretty much like an audio book, but like like a video audio book with some explanations and some questions also and everything. But yeah, like I said again, this is like I'm doing it for me right now, and this is not catered towards any audience. This is not custom made. Obviously, you can see the lack of anything, in this video. But I think for my purpose right now, which is to stay consistent with reading this book and attempting the questions and really understanding all the concepts that are given in this book as much as I can, and perfecting this craft as much as I can. I think this will achieve that purpose because I like what I just did in the last 20-25 minutes. And yeah, I think that'll be it. I'm going to the gym right now. And yeah, see you hopefully tomorrow.